GM, good morning. Welcome to the Milk Road Show, the daily crypto show that explains everything as clearly as your super smart, nerdy friend who somehow makes quantum physics sound simple. I'm your host, Jay Hamilton, and today we are joined by Kyle Reidhead, co-owner and head of research for Milk Road Pro. Today is a super exciting day, guys. I've been telling you over the past few episodes about a guide, an investment framework that Kyle and the Milk Road team put together. These guys have been cooking, absolutely cooking in the kitchen for months. And they put together a framework that is dead simple and gives you everything you need to make money in this cycle in the next 12 months. Straight up, this thing is absolutely fire. I can't believe how good it is. There's so many amazing takeaways, and it's done in such a simple way. Also, there's some really, really great stuff about how to allocate in your portfolio, but you're going to have to stick around to the episode, to the end of the episode to hear that. Now, in order for us to tell you guys about this framework that they've come up with that we're going to share with you today, I'm going to show a bunch of visuals in today's episode, more than we usually do. So if you guys want to switch over, you might want to switch to YouTube, or if you're on podcast, you might want to make sure you can see the video. If you're driving, please don't drive and watch the video at the same time. Super dangerous. Be careful out there, folks. But before we jump in, we just need to take a minute to hear from our sponsors who make the show possible. Do you own your data? Nope. Every post, click, and search you make is controlled and monetized by unseen giants. I've had enough. It's time for Navigate, where their mission is to give back data ownership to you and share profits with you. That's right, money in your pocket. How, you ask? First, the Navigate browser extension makes it easy to turn your everyday browsing into passive income. Second, the Data Quest game, where you can boost your earnings and help train their AI. Visit navigate.io today to earn and own your data. Meet Uphold, a trading platform that's changing the way you think about money. Imagine this, earning up to 4.9% APY on your US dollars. No catches, no lockup periods, and no fees. And yes, it's FDIC insured up to $2.5 million. They offer access to over 300 digital assets, which you can trade, store, and exchange with confidence, knowing Uphold operates with a 100% reserve and a transparent model. Create your account, fund it with a few taps, and you're ready to go. Click the link in the description and join Uphold today. Kyle, what's going on, my man? Welcome back to the show.
Hey, well, glad to be here. I want to be that nerdy friend that can explain quantum physics, but I can explain other things like crypto and investing, but not quantum physics, unfortunately. But also, just to add to your intro, this isn't about just making money over the next 12 months. This framework that we're about to share in this episode is about making money in every market that we're in throughout the entire cycle, ups, downs, everything. We're going to show you how to allocate and how to understand what's going on in markets. So it's a big thing. We're pumped.
I'm super pumped. Okay, let's start off with the simple question that is sort of the foundation to this investment guide, which is, what moves crypto markets? What is the lever that leads all crypto markets to move?
Yeah, I mean, I think we've explained this one time and time again, which is global liquidity. At least right now, it's global liquidity, right? Like, it might not always be, but global liquidity is what moves crypto. It's what moves tech. It's what moves gold. It's what moves most things at the moment. More on a long-term time frame, but oddly enough, with crypto, when you look at Bitcoin price chart versus global liquidity, as you have up on the screen here, it's pretty accurate, like in the moment. So like as global liquidity goes up, crypto goes up, right? It's pretty wild how close it is, but generally over the long term, you're going to see it match up very, very well as well. So global liquidity is what moves kind of all markets, and it has for a long time. I would say in this moment that we're in, which we did an episode on this months ago, but since kind of the great financial crisis back in 2008, we've been in this like monetary policy dominated world where global liquidity really, really matters. Previous to that, it wasn't as much moving markets because there wasn't as much being printed. We weren't so much in debt, and now we are. And so global liquidity is really what moves everything. But what you really want to understand is not just global liquidity, but it's actually, there's something that moves global liquidity, and that is the business cycle. We've talked quite a bit about the business cycle, or at least I mention a lot when I'm on the episodes, and I'm sure other guests do. But we've never really like dove into what the heck the business cycle really is. And I think this is probably one of the most important things to understand if you want to invest in not just crypto, but anything, because the business cycle has been around for like hundreds of years. And it is really the framework that we base our investments on. And when you understand the business cycle, you kind of can understand. I don't want to say everything. It's not like the most perfect thing in the world, but when you understand it, it makes investing just so much clearer, I'd say.
Okay, so it's not the Bitcoin halving that moves crypto markets
No.
as so many people think. So if you think that, scratch that from your mind.
Interesting though, Bitcoin was created because of the great financial crisis that I just talked about. And so it was created like basically the year after that. And so the halving, of course, is every 4 years since when Bitcoin was created. So that's actually what happened here, right? It kind of lines up the same with this because when the financial crisis happened, we had to go into all this monetary policy not too long later. And so they happen to line up at the same time, but that's not what caused it. Though, like, I'm sure it helps. It's just not the main thing driving it.
Okay, so global liquidity moves crypto markets. What moves global liquidity is the business cycle. Obviously, we're going to explain the business cycle to everybody. But before we do that, there's just one more key foundational point I think that everyone needs to understand here. And that is, if we are going to invest in these business cycles, if business cycles are going to be a key to our framework, you need to invest in secular trends. Those are what fit the business cycle. What are secular trends? Can you explain that concept to us?
Yeah, for sure. So let me just explain real quick. So the business cycle itself is the growth of the economy. Okay, you can think of the global economy growing and growing, right? And sometimes it grows really fast, and then sometimes it slows down a lot. You have a chart up right now that shows kind of the expansion of the economies, and then you have like the contraction of economies, and they go up and they go down, they go up and they go down. But long term, if you look at the black line in the middle of it, although there's these crazy ups and downs, long term, we're always going up and to the right, no matter what. That is the business cycle working around a secular trend. The secular trend is that just growth in our world is growing. Our economies are growing because we have more people, we're becoming more efficient with technology, et cetera, et cetera. And so for the last, I don't know, basically since the beginning of time, our GDP or the growth in our economies has just grown and grown and grown. Okay. And that is a secular trend. That's something that's probably never going to stop. Although our population decreases, I talked about in an episode months ago, that could slow down our growth, but we think we have technology that's going to fix that. So anyway, a secular trend in just that our economies get bigger and bigger and bigger, right? We consume more and more and more over time. We produce more and more over time, and we sell more goods more and more over time. So that is a secular trend that you can always bet on, that we're just, even if there's these ups and downs in terms of how fast we do those things or how much we grow, you know that our economies are always going to get better. And if they don't, well, we're going to collapse. So we need them to always get bigger and better. So a secular trend is basically just a long-term trend. And so first, you can understand that the business cycle is always up and to the right, though it will have these crazy ups and downs. We'll talk more about that in a second. But if we think of other secular trends, let's think about the United States. The United States has been the most dominant country for the last 100 years. And so a secular trend is the growth of the United States economy. Well, how can you invest in that secular trend? The S&P 500, right? The S&P 500 is basically just the top companies in the United States. And you could have invested in them anytime for the last, I don't know, since the S&P 500 has been around, which is like close to 100 years. And again, it will go up and to the right. Now, again, it will go up and down in the short term. But a secular trend is that the US economy is just getting better and or bigger and bigger and bigger. And so the companies that make up that economy will grow in size. And they've done this for 100 years, right? So that's an easy secular trend to understand. The next secular trend you can understand is the NASDAQ. This is technology. The internet is the easiest way to understand this, right? Since the 90s, we've done nothing but bring more and more people online, more and more companies online, and more of what we do every day online. And so there's a secular trend in just the internet adoption. The best way to represent that in an asset class is the NASDAQ. These are the top 100 technology stocks. Basically, all of them are internet stocks, right? Or rely on the internet in some way. And so again, if you wanted to invest in the secular trend of the internet, you just bought the NASDAQ. You could also buy specific companies, of course, but you can just buy the NASDAQ, and you can see here up on the chart you have, it's just up and up and up over time for the last, whatever it's been, 30 years or so. Again, it has its kind of expansions and contractions along with the business cycle, but ultimately it's a secular trend. You could buy any time in the last 30 years, and especially right now, we're at all-time highs, and you would be up. Okay. There's one more secular trend that we'll talk about, and that's what's going to matter for the listeners today, which is crypto. This is the on-chain revolution, which started back in 2009 with Bitcoin. And now we have a secular trend of people moving on-chain. Okay. And so again, same idea. It will move with the business cycle. It will have its ups and downs, but ultimately, because this technology is so good, more and more people are going to come on-chain over time. And that is a secular trend that you can invest in and be a part of. So just like you could invest in the S&P 500, if you wanted to take the secular trend of the US economy, You can invest in the NASDAQ if you want to take the secular trend of the internet. And then you can invest in either Bitcoin or just like in crypto in general, and look at the crypto total market cap is what we have up here. And that'll show you the secular trend of crypto.
Okay, so we've got these secular trends that are consistent, that basically follow this never-ending growth. They are going to continue to grow. And these secular trends, you could see them in those graphs there, they follow something. And what they follow is the business cycle. So let's break down the business cycle so everybody can understand what is a business cycle.
And the key to understand here is that, so assets themselves are not predictable. They're very tough, right? To predict if Bitcoin's going to go up or down, or if the NASDAQ is going to go up or down, or if the S&P 500 or specific companies within that are going to go up and down. But what is predictable is the business cycle, because we've had the business cycle for so long. And there are many, many indicators which tell you what's happening with the business cycle. And so if you can start to predict the business cycle, you can start to predict the ups and the downs of the NASDAQ, the S&P 500, and for crypto, for any of these secular trends. So if you understand the business cycle and you get the leading indicators, the way that you can start to see where the cycle is heading, where we are now and where it's going to go, then you can start to make Bitcoin and other assets predictable. That's the key thing here that we're going to talk about. So let's dive into what is the business cycle. We're going to break it down into 4 seasons or 4 sections, which is going to make it super easy for you guys to understand. But like, before we get into that, let's just understand what this is ultimately. And so again, the business cycle is the growth in our global economies. Okay. If you want to think about it like the US economy, that's fine. But ultimately, it's the growth in an economy. Okay. Here's how the business cycle works. There is a combination of the business cycle is generally understood by looking at inflation and looking at GDP, gross domestic product. Okay. So this is like how much is the economy making in revenue? And based on that, how much are prices going up or down for all the things that are bought and sold in an economy. Okay. And then there's one thing that sort of helps to control that, which is the central banks, the Fed. We talk about the Fed in every single episode, basically. What are interest rates doing, et cetera? The Fed moves rates up and down to sort of control inflation or GDP. And they also can print money to control inflation or GDP. Okay. So those are the tools we have to impact the business cycle. In the world we live in now, the business cycle is basically controlled by central banks. And that's why it's key to understand both of these things. But let's just walk through what a full business cycle would look like. And we'll do it in terms of like the real economy, in terms of like, where are you and what is this? How does this impact your life? So let's start here. In an economy, we'll start when there's too much growth. Okay. So we had too much growth in 2021, right? Things got too crazy. And so when you have too much growth too fast, what happens? We have an increase in inflation, right? Now, why is that? Well, it's because there's too much demand to buy things. And so companies either can't keep up with that demand, that they start increasing their prices, or they realize, hey, we can start to increase prices because there's so many people in, right? And so all of a sudden, when there's too much demand, there's too much money out there, everyone's consuming. You think 2021, the governments were just giving away free money. Everybody had a job. The stock market was booming. And that's because everyone had all this money. And so everyone was consuming and spending. Companies were doing great, et cetera. What happens then? Inflation goes too high. Now, in this space, or in this time in 2021, inflation went high because of structural demands, because we just shut down economies and we had a war, et cetera. So like, it was a little bit different, but ultimately inflation got too high. Okay. And so what happens when inflation gets too high? Well, all of a sudden we need to lower the price of goods, right? Or not allow price of goods to go up any higher. And so to battle inflation, central banks will increase interest rates. So what happened in the end of 2021? All of a sudden, central banks around the world started to increase interest rates. The reason they did this was inflation was getting too high. And so if they increase interest rates, what happens? The average person who has a mortgage, a car, they have loans, they have credit cards, et cetera, if they have any debt, all of a sudden, all that becomes more expensive, right? Your mortgage payments every month go up and up and up. Every time they increase by like 0.25%, right? Or 0.5%. You hear this all the time, these raising or lowering interest rates. What they're doing is making it more expensive for everyone in the world. Your expenses are now going up, even though nothing's changed. Okay. Just some guy at a central bank decided we're going to increase this because inflation is getting too high. And so what happens is once they get high enough, people's expenses get too high. And all of a sudden they can't afford things anymore. And companies' expenses get too high. They can't take out loans, and they can't, their cost of their offices, et cetera, go up. And so all of a sudden everyone is like a little bit broke. And so what happens in this world? Well, companies got to start laying people off, right? They can't hire any more people, and they got to actually like reduce expenses, right? Reduce their payments. And so then all of a sudden people lose their jobs. People don't have as much extra money because their expenses are too high, because their mortgage payments went up. And then what happens? Well, all of a sudden people stop consuming. And so when you stop consuming, inflation starts to go back down, right? The prices of things are still going up generally because, again, we're in a secular trend, right? The growth of the economies are still going up, just not as fast. And so maybe instead of 9%, it's like 3%, right? So as inflation comes back down because people are losing their jobs and they don't have as much expendable money, then what happens? Well, the central bank will start to lower rates again, right? That's kind of the world we're in right now. We just started having the US lower rates last month, and now we're seeing rates go back down. And if you have a home right now or you have a car that you are financing, you'll notice you're getting a little bit of extra cash every single month, right? Because your mortgage payments are going down. And so as they lower those rates, all of a sudden people start spending again. And all of a sudden the mortgage market goes up, the housing market goes up, and people start buying, going to restaurants again and buying whatever luxury goods, et cetera, et cetera, et cetera. And people start to spend once again. At the same time, what happens is that generally there's a delay or a lag to this. And so the government will start, or the central bank, I think they're kind of one and the same, but whatever. They start to print money. They need to stimulate the economy because companies have had to lay people off. People don't have any money anymore. And so they start to give out money to companies, and they start to say, hey, here, it's now cheaper to take out loans. And so take out a bunch of loans. It's going to cost you, next to nothing, or we're going to subsidize certain areas to help them grow. And that's going to stimulate the economy once again. That's kind of where we're at right now. And then the same cycle happens, right? They do too much, rates go too low, people start spending a ton again, and all of a sudden inflation starts to go up. And then the same cyclical nature happens once again. That is the business cycle. And that is how it looks like and feels like as the average consumer. So there's a real part to it that you know and feel on a daily basis if you own a home or a car, et cetera. And then there's how does that actually impact markets? And again, if you think about it, if a bunch of people are spending, it means companies are doing well, right? If rates are low and I can take out loans and my mortgage payment's low, I can go buy a new iPhone. And so all of a sudden Apple's stock goes up because their revenues are better, right? Their earnings are better, right? And so what's happening in the real world eventually comes to and happens and correlates to what's happening in the markets as well.
Okay, so the business cycle is cyclical because it is tied to a few key dynamics of growth and inflation. And both those growth and inflation are impacted by the central banks and how central banks react by altering interest rates or by increasing liquidity by printing money.
Even if you took out the central banks, this would still happen. It just wouldn't happen so specific, but if people start spending a ton and prices start to go up, just the fact that prices went up means people will have to start spending less as is, right? So it would technically balance itself out. It's just our economy is so much debt that we can't really let it balance itself out because that would just take too long and things would blow up, and the government and the central banks don't want things to blow up. And so they have to they basically have to keep that pacemaker that I talked about in that other episode, where they'll have to control it and make sure that it goes up and down kind of in a good, gradual, predictable way where nothing gets too crazy. But ultimately, it would kind of work itself out. But the central bank just sort of allows it to be hopefully smoother and more cyclical.
But the outcome of the central banks being so involved is that this actually becomes quite predictable and a pattern that you can see happening every 4 years consistently for quite a while now. We've been through many of these cycles.
Well, I was just going to say you can simplify it. So if you want to bring up the 4 seasons of the business cycle, why don't we just simplify it this way? Because I know it was a lot what I just explained, but it's as simple as this. There are 4 seasons, let's call it, to the business cycle. Okay. If you're looking at this chart right now, that dotted line is your secular trend. Okay. And it is kind of the average growth, let's say, of the economy. When we're below it, it means we're below the average. When we're above it, it means we're kind of expansion mode, right? We're much higher than we need to be for growth. And so if you look at these 4 seasons here, we have winter, spring, summer, fall. Don't get confused. This is not the same as your weather seasons. This is just to do with the business cycle. It's kind of a made up thing, but I think it really helps for people to understand. So spring, which I would say is we're just ending right now, is a disinflationary boom. So this is a time where you have falling inflation and yet rising growth. And so what this means essentially here is that inflation has started to become lower, and that's happened because central banks usually have interest rates much higher. If you think of over the last year, we've had very high rates. And so inflation has come down from, I don't know, in the US, it was 9% or something, down to below 3%. But at the same time, at the tail end of the spring here, we've started to see growth pick up. So the economy's starting to get better. Why? Well, we're printing some money, rates are getting lower, etc. Then you get into summer, and summer is this inflationary boom where growth is really picking up because interest rates are basically at all-time lows, right? Think 2020 or 2020, well, I guess more 2021, where rates are low. The government's printing money because they're trying to really stimulate. They want to make sure there's no cracks or anything blowing up in the economy. And so like things are on full force. We call this full risk on. This is the best time to be investing. This is when kind of everything goes up, the 2021 days. And this is rising growth, but also inflation is beginning to rise at this point as well. Still early days on inflation, but it's beginning to really pick up here. Then we have fall. Fall is where growth is slowing down, but inflation is still rising. Okay. So we can't really grow anymore. We've got to start pulling back with the central bank because we're printing too much money. We got to slow down how much we're printing, et cetera. But inflation is still rising at this point. Then we go to the point where, hey, okay, we're raising rates a ton, right? So in fall, we start to raise rates. In winter, the final stage, this is where rates are high, right? And growth is slow. Inflation is beginning to slow down. This is the point where like no one's buying anything. People are losing jobs and the economy is struggling. People are scared. You hear the recession talk all the time. That's winter. This is risk off. Okay. This is what we call the deflationary bust. But then what happens is the central banks change their tune and they start printing some money. They start talking about that they're going to raise rates again, right? They pause increasing rates and they either pause it and keep it there or they say, hey, we're going to start lowering. And that's what gets us back into spring, right? And so we're still below average in terms of growth, but we're starting to rise. That's the best time to be investing. That was your January 2023. If you knew that the business cycle was turning and we were entering spring at this point, that was the time where you wanted to allocate. We had mentioned a ton to pro people, like this was the time to be allocating, and boom, we had an amazing 2023. And then now we're just kind of ending our spring, and I think we're moving into summer, which is again, rising growth, inflation. I don't think inflation is going to rise too much, but generally you'll see some inflation rise. And again, this will be more at the tail end of summer. So it could be end of next year type thing.
Okay, couple quick clarifying questions, and then I want to ask, how do you use this in order to make better investments? But before I ask that, how long is a typical business cycle? And then how long is a typical season? And how easy is it to know where we are within this business cycle?
So, okay, length. So generally it's very random, but because we're in a monetary policy dominated world, it's actually not random at all. They're basically every 4 years, the same with Bitcoin halving, which is weird, but just sort of how it works.
Coincidental, totally coincidental.
Completely. And it won't always be that way. It's just sort of how it is now. I think it will continue that way for now, but mainly the reason we won't get into it, but it's because the debt from governments, they have to refinance every 4 years, 3.5 to 4 years. And so they have to lower interest rates to refinance, which is where they're going right now. And that happens every 4 years. And so I think that's probably what's controlling the business cycle. Anyway, so generally that. In terms of these seasons, it can vary as well. I would say it's around a year, but it could be more. I mean, we've kind of been in spring for a year and a half, right? And so it can be anywhere from a year to upwards of 2 years, but sometimes season can actually be even shorter, right? Like if you have a long spring, maybe we're gonna have a short summer, or maybe summer's the normal and we'll have a short fall. Like, I don't know, but it kind of varies. So generally around a year, I would say.
I also asked, is it hard or difficult to know which season we're in?
I wouldn't say it's an easy thing for sure. There's a lot of metrics. And I think the finance world and the economics world probably like overcomplicates it, which can make it very difficult for people. But ultimately what you're looking at, I mean, from our chart that we just showed, it's all about inflation and growth. So if you look at GDP, you look at inflation, that's going to help. But what you need to understand is the leading indicators of that. Where I said that the business cycle is predictable, it is if you understand the leading indicators of inflation and of growth. And that's where things get difficult. There's many leading indicators. They're hard to track. And so I wouldn't say it's an easy thing, because also the other thing is you want to predict ahead. You want to know where's the business cycle going to be 6 to 9 months from now so that you can invest ahead of time. You don't want to be like, okay, where are we right now? And then invest based off where we are now. That's the last thing you want to do, right? The best time to be investing was at the tail end of winter, right? But at that time, it still felt really, really bad. But if you knew that spring was coming, that's when you want to be investing. So it's definitely not easy. We update this chart now in Pro I think it's on Tuesday, maybe it's Thursdays now actually. And so every single Thursday, we show in the newsletter for Pro members where we are in this cycle, and we comment on it and we update. So if you don't want to try to figure all this out and be an economist, you don't have to be. Myself, Martin, and the rest of the Pro team, we do that for you. And so you can learn that just by being a pro member every Thursday, which is going to make your life so much easier, because there is a lot of data and things that you kind of got to parse through to figure out where we are here.
Okay, so now what? Now I have this information. I know that there's these 4-year business cycles, that we have these seasons within these cycles. What do I do with that information? How does that? We're obviously not in winter, as you had said. Had we known that we were in winter and we were going into spring, we would be saying, hey, everybody, now's the great time to buy, but we're not. How do I use this information for my investment portfolio?
Yeah, so I'll give a bit of a general take, but I think the best way is there is a guide that we shared where we kind of walk through this in a little bit more detail than what I've explained in the podcast. And in that, we actually break down the portfolio allocations. It's a lot to explain in the podcast, so I'm not going to do it, but it's free. Anyone can get this guide. It's in the show notes below. So go download that and we'll show you the actual allocations. But basically, the gist of it is this. There is, and you can see from the image here, we say risk off in winter, risk on in spring, risk on in summer, and then neutral in fall. And really what you want to understand here is that in spring, especially early time in spring, it's risk on, but it's not full risk on. It's not like meme coin degeneracy risk on like it was back in 2021. It's risk on of like, hey, we're going to start allocating again to riskier assets. And so this is why tech will start to do really well in the spring and crypto will start to do really well, but mainly it'll be Bitcoin. It's usually led by Bitcoin. It's not going to be all the alts. Now, Solana also did really well, but it's because it was so undervalued. That was just an obvious trade back in spring. And again, that was 2023 early days. And so risk on, but not crazy risk on. We'll call it not degen risk on in spring. In summer, that's your chance to go full risk on. That's where you can buy whatever you want in crypto, and it's probably going to do well. This is your altcoin season, is what most people call this. But also tech will do really well, right? So in spring is when your Apples, your Google, your Nvidia, the biggest companies in the world will do well, and they'll come back and tell the market, hey, we're going back to risk on. In summer is when the small caps will do well. Your Russell 3000, the tiny startups that are overvalued or just crazy, they make no sense. The things that are like these crazy robotic, whatever companies that like no one would invest in during winter. It takes summer for people to start investing in those things and capital to move its way there. Part of that is because companies have already made money in spring from the kind of less risky assets. And now they move their capital from the less risky to the more risky, right? And so that's summer. That's where we're heading into right now. I think we've talked a ton about how we think altcoin season and crypto summer is coming. The banana zone, that's your summer.
I mean, is the Michigan State Pension Fund buying the ETH ETF today? Is that an indication that we're entering summer or what?
Well, I don't know that the Michigan State Pension Fund is trying to invest around the business cycle. I think they just invest for long term, but at least that's what I hope. But yes, I think they're getting ready for the banana zone, aka the summer for the business cycle. Fall's where things get a bit tricky. So fall is a time where assets can actually do really well, and probably it's the most riskiest in terms of like risk on environment. So like there's money to be made. The tail end of the most riskiest shit will do really, really, really well. This is when altcoin season really outperforms Bitcoin. If you remember in 2021, ETH and a bunch of these other alts just dominated Bitcoin later in 2021. Bitcoin barely moved. It still did well, sure, but it was so outperformed. But then you need to be preparing for winter, because at some point in fall, things start to change. And that's where you have your top, is generally in fall, and we start to go down. Now, the problem is that in summer and fall, things are so crazy that things go up and down and up and down and up and down, but ultimately up and to the right. But it's hard to tell when the top comes. The top is coming in fall. And so my suggestion is always you start taking profits end of summer, early fall, and you start preparing. And by the end of fall, you are already fully allocated to winter. Again, for the exact percentages and how to do this, check out the guide that we have. Again, it's in the link in the show notes below. And then in winter, you want to basically be out of assets. You might want to hold like some Bitcoin or some like low risk crypto or low risk tech. But generally, you're going to do that knowing you're going to probably go down X%. And in crypto, it's quite a bit. For many, though, it's difficult to just move fully out of crypto or fully out of tech. For a lot of people, that doesn't really make sense because if you're not fully in this and knowing what's happening day to day, like you're going to miss. Remember, these things move so fast, right? To the upside. So once the markets sniff out spring, like they're going to just move. And so sometimes it's better like to just hold it long term all the way through these cycles if that's easier for you. But again, if you want to play these cycles more, then you want to be out. You want to be in probably stable coins. You want to be maybe getting some yield in your stable coins if there's anything there. But you want to be, winter's a time where things blow up. That's your FTX implosion, your 3AC, like 3 hours capital blowing up. Like you want to be out of markets because anything can happen at this point. And so you want to be just building up your stack, holding stable coins, trying to find some yield. And at this point, it's generally very easy to get yield because in winter, interest rates are really high, right? So it's very easy to get 5% or whatever, at least this winter. It was easy to get 5% just from holding dollars in US treasuries, right? And so it's a time to just get yield and just don't get wrecked. You can make money in from your yield, and that's about it. So you actually expect to lose money probably during winter unless you fully get out. The problem is it's not easy to predict exactly when we switch or transition from one season to the next. So as much as this makes it super easy when you look at it, it's not a perfect science, that's for sure.
But it is a guide through which to make informed decisions. And what I love that you're saying about the portfolio allocation is, and I think this is a mistake that a lot of investors make, and everybody listening, I'm here to make sure you guys don't make this mistake this time around. If you've made this mistake in the past, is to understand that your portfolio needs to have a plan for each different cycle, each different season, sorry. And so that might mean that in some seasons, your very heavy majority of your portfolio might move to stable coins. And then in other seasons, you might move more into Bitcoin. And then in other seasons, you're moving more into altcoins. And as you said, there is in the guide, you guys got to download the guide. It's so killer. It's incredible. It has an exact allocation of what you should do for each season. And it's so helpful to see.
And again, remember, these seasons are a year plus, right? So this isn't how you trade on a weekly basis or a monthly basis. When you hear inflation is going to go higher on Twitter, you don't sell. You look at what season are we in, right? And you're like, okay, well, when is that inflation going to go higher? Is it really? The thing is that I've been yelling and screaming that inflation is going to go down for the last year and a half. I only knew that because of the business cycle. It had to go down. It made no other sense for it to go up. Yet everyone has been telling you that inflation is going to go up. And so what this does is it really separates all the noise that's out there on Twitter and on the news, et cetera. And it allows you to go, okay, does it make sense that inflation would go up right now? It's like, no, of course not. That makes no sense because we are in winter or we are in spring, right? And so the whole point is to use this to just like get rid of all that noise, but then you need to hold throughout that season, right? And sometimes like we were early in putting the Milk Road Pro portfolio into summer, and it's taking a little bit longer than we expected, okay? But again, we think we're fine. We're not making any changes because we feel like we know summer's coming and we're going to hold throughout that entire summer, right? And so again, it is a long-term strategy, but it allows you to optimize throughout that sort of 4 or 5 year long cycle.
Yeah, and it really allows you to, as you said, to try to predict what's coming next and get ahead, maybe even if you're ahead too early, as maybe the Milk Road Pro portfolio has been for the past few months. We still expect that summer is coming. Kyle, for everybody listening, any final thoughts on how they should be knowing that we're in spring, end of spring, heading into summer? Final thoughts on how somebody should be thinking about their portfolio right now in that season?
Yeah, I mean, I'd be buying, looks like there's been a dip the last few days here pre-election. I'd be buying the hell out of that. Obviously, we'll see what happens. I think this is going to be live on Tuesday when the election actually happens. So we'll see what goes on there. But I think you want to be risk on. I think after this election, generally what we've seen every other cycle, and basically what we're seeing in terms of the macro metrics, in terms of inflation, which is lower, and growth, which is continuing to rise or looking pretty good. And again, it's not month to month. Things change and fluctuate month to month. It might be down this month versus last month, both inflation or growth. It's where's the trend? And right now we are trending where growth is probably going to go up. Inflation will continue to stay down or lower for a little bit. And then eventually we'll start to see it back up. And that'll signal where we're at. Right now, though, it's full risk on. I think we're entering banana zone, and it's going to happen anytime this month. And so I'd be fully allocated at this point. Pretty much no stable coins. I mean,
love to hear it.
Have cash. Banana zone. Always have some cash. But in terms of your investment portfolio, okay, of course you need to have your rainy day fund. That is a must, no matter what season we're in.
Yeah, great advice. Kai, thanks so much for joining us. Thanks to you and the team for putting this guide together. As we said, this guide is free. You can download it by clicking the link in the show notes, or we've had a QR code up on screen throughout this YouTube. Scan that QR code and you can download the guide. and make sure you are prepared to allocate for all seasons, and also build your own thesis and your own investment framework, which is going to help you sleep more comfortably and make better decisions throughout the cycle that we're in right now. Kai, thanks so much again for joining us today. Have a wicked awesome day, everybody. As always, if you liked today's episode, please hit subscribe and make sure you follow us so you don't miss out on the next one. There's also a link in the description to our free 5-minute daily newsletter where we simplify crypto for you while making you laugh. And if you're willing to step up your crypto investing game, we're going to also leave a link for Milk Road Pro. You get access to our portfolio where you can see exactly what we are buying. This is your number one resource to help you invest successfully in crypto. One final note, this show is for educational purposes only, and nothing we say is financial advice. Investing in crypto or any asset is risky, and you should never invest more than you can afford to lose. Thanks so much for listening in, my friends. Have a wicked awesome day.